we're going to get. Aaron Kennan at Clear Harbor wrote me a message yesterday on Twitter. He said the following: the dilemma for many investors at the moment, allocate capital towards the inflationary picture or allocate to the increasing likelihood of lower growth and incrementally higher unemployment. I suspect the likely outcome is higher vol and lower valuations for now. A range of opinions. There's one. I'm looking forward to catching up with Aaron a little bit later through the next month or so. Coming up, President Biden ramping up military aid to Ukraine.
Now I'm once again using my presidential authority to activate an additional security assistance to continue to help Ukraine fend off Russia's assault.
That's next. This is Bloomberg.
Now I'm once again using my presidential authority to activate an additional security assistance to continue to help Ukraine fend off Russia's assault. An additional $800 million in assistance. That brings the total of new U.S. security assistance to Ukraine to $1 billion.
President Biden expanded the arsenal for Ukraine as Ukraine's leader pleads for more aid, more military aid and more sanctions. Those sanctions are already hitting Russia. The default countdown kicked off already this week. The bond payment is still in limbo from yesterday, 2 interest payments, about $117 million. BlueBay's Mark Dowding said this: expect the pain to last. Russia will be in the isolated wilderness for a long time to come. A regime change is probably a prerequisite for reinvestment, along with lifting sanctions. Damien Sassower of Bloomberg Intelligence is back with us. Damien, go on the reporting and let's work out what's happening here. Have they sent the money over towards the investors and through the bank?
So my understanding is that Finance Minister Sulanov, Russian Finance Minister Sulanov, did indeed send the dollars to his correspondent bank for payment on to Citigroup of London, who is the payment bank that has to make payment to creditors. We've heard nothing from Citigroup. We don't know if they've actually taken in that money, if they're actually going to pay that money. We know that Citigroup's back office has had some issues in the past. Revlon, for example, they made an erroneous payment, about a year ago. But that's neither here nor there. The reality is we just don't know if they're able to make those payments. We don't even know if they've received them at this point. But let's just say, for all intents and purposes, Jonathan, that they have received the money and they're going to pay the creditors. Well, then we look backwards and forwards. We look backwards to March 2nd when Russia defaulted on its OFZs, its local debt, and assuming what Fitch says, there's a 30-day grace period on that, unconfirmed. That takes us through to April 2nd, and that may constitute a default. And we all look forward to April 4th, when $2 billion of principal are due on Russian bonds. And so, yeah, the game goes on, and it's just like a shell game here,
This
Jonathan.
can get messy quickly. We don't know if Russia sent the money. We won't have confirmation of that until the corresponding bank can actually say we've received the funds. We have to take their word for it. Some people might be unwilling to do so. Can we go on the theory just for a moment, Damien? Theoretically, can the corresponding bank accept that money from the Russian sovereign?
I mean, I don't know. I mean, look, they can if they get special dispensation. If the government, I mean, this is kind of what's going on here. If the government allows them to receive it, yes, they can, right? But, I mean, according to everything we're reading, everything we're seeing, they're really not able to receive, they're not able to transact with Russian banks. They're not able to transact. So, the verdict is still out, Jonathan. I mean, if you look at some of the, corporates that have paid, Gazprom, Rosneft, they actually had to receive dispensation from the Russian government in order to move those monies to their creditors. So, there are two sides of this coin, and far be it for me to opine either way. It's just a matter of wait and see, and at this point, we just don't know.
Can I just get some additional clarity as well, Damien, as to whether they did pay that in dollars? You indicated they did. They threatened to pay in local currency.
Yes.
Are they saying they've sent that money in dollars?
Finance Minister Sulanov is absolutely saying that they have every intention of making that payment in dollars. That's a key point because these bonds don't have the fallback optionality where they can pay in rubles.
So how many days left? 29, 28?
29 and counting.
Wait and see.
Yeah.
Do you think we fully realise the consequences of what happens once that grace period passes and perhaps the money doesn't turn up?
Well, Jonathan, I mean, this is a good question because, I think the default is kind of baked in at this point. It's really what's the real economic impact? I mean, don't get me wrong. There's a lot of offshore creditors that are already marked those bonds down, and they're going to get into a restructuring, a very complex restructuring in order to see just what the recovery is. I think BlueBay, Mark Dowding actually estimated something in the order of, 25 to 40% recovery when all is said and done. But timing is everything. How long does it take for them to recover, their investment? That remains to be seen. So look, we're sort of in limbo still.
Damien, throw in China as well. Can you tell me how isolated this story is at the moment within EM? Has it started to bleed out?
So
we're seeing waves, ripples.
So no, we are. If Russia's been kicked out of all these bond indices, right? So that means two things. Who's going to take the place of Russia in these indices? So going forward, high-yielding emerging markets like perhaps Egyptian local bonds or Indian local bonds, both of which are being added to bond indices, or that process is ongoing as we speak, they should benefit from this. Also, forward, and on the flip side, those EM local debt markets that are most liquid, most heavily weighted in indices, China, Indonesia, and Thailand, are most at risk because if you can't sell your Russian bonds to meet your redemptions, you're going to sell the most liquid stuff in your portfolio, and that's CGBs, Indonesian government bonds, and Thai government bonds, and so forth.
Damien, we've got a lot of work to do through the next 28 days or so, and you're going to make it easier for me. Good luck to you. Yeah. Damien Sassower there of Bloomberg Intelligence. Let's keep it on China, allowing some companies to restart factories amid lockdown in Shenzhen. When is a lockdown not a lockdown? And do lockdowns always look like lockdowns did back in 2020? Paul Donovan of UBS taking issue with that, saying the problem is that people hear lockdown and instinctively think of what happened in 2020. That is not what is happening now. Let's get back to Abby for more. Hey, Abby.
Hey, John. Well, you know, this is really interesting because, of course, on Monday, the sky was falling. 51 million people in China were locked down, and the interpretation was that it was a hard 2020-style lockdown, whereas now it seems as though it's loosening up in terms of what's happening over there as far as what it might mean. And there's a piece of this is the fact that new confirmed cases have actually dropped for a second straight day. On Monday, they were up fourfold over a week, so now it's going in the right direction. And in fact, one Hang Seng economist expects the factory closures in the south and in the north to be just 2 weeks as opposed to what felt like it could be for a long time and really influence the economy. And in fact, that important Foxconn, partially they've resumed some of their Shenzhen production. I don't know if that includes the iPhone plants, but it may. So it seems as though there's some hope for the China economy around these new lockdowns. That could be a reason for why we have this monster rally, historic rally for many of the China indexes. That CSI 300 over the last 2 days up 6.4%. The Hang Seng up nearly 17%. Hang Seng Tech amazingly up 32%. Today, though, taking a little bit of breather. That makes sense because, of course, yesterday, that Golden Dragon Index here in the U.S. up 33%. It's best day ever. I can't ever remember an index being up 33% in one day. So today, some consolidation. But on the other hand, John, oil, as you know, right now at $101 per barrel, above $101 per barrel, up 6.3%. That probably reflects some hope that the China economy is not going to be hit quite so hard by these lockdowns.
This ADR story as well. We have not sorted out that audit issue, have we, Abby?
You know, it's really incredible, this volatility both to the downside and the upside. I would say that the really key point to think of here, though, is that these stocks down 75%, then that monster rally, they barely made up any of those losses. A lot of folks are telling me that it's like catching a falling knife. In fact, I spoke to Paul Ciano over at Bank of America, and he was saying that people really aren't reaching out yet because of that risk. But let's see what happens here. It's pretty interesting, but it's going to depend on these fundamentals, plus the important issue of where China falls on the Ukraine-Russia war.
Abby, thank you. Headline roulette is never an enjoyable game, is it, when it comes to Chinese policymakers? Their intent is important, always is. Can it change the other way quickly, though? I'll let you decide. The Hang Seng got more than 7% of the close. The CSI 300 up about 2%. With your sector price action for today's price action, 22 minutes in, here's Kriti Gupta.
Well, good morning, John. Of course, you are seeing some divergence in the markets right now about flat in the S&P 500, but it's really because you don't have tech on your side. In fact, tech weighing the entire market down. What isn't weighing the market down is energy. It is up, and it is up by a lot, up 1.7%. And if you look underneath the hood, once again, it comes down to those favorites, the energy companies that have that extra exposure to U.S. production, Occidental, Marathon Oil, Halliburton, and Occidental getting an extra bid. It's actually your best performer at the moment after some reporting that Warren Buffett is now building his stake up in the stock. 14.6% of the company is just how much he owns right now. And this is really important because, of course, we know that financing for the Anadarko deal came partly from Warren Buffett. And nevertheless, it kind of seems like other investors are taking his lead and really boosting those energy shares, John.
Kriti, thank you. Kriti Gupta on the sector price action. And move on, Brent. Brent crude 105, WTI 101. Let me leave you with this one just quickly from Citi and Andrew Hollenhorst. Investors should heed this warning and expect the Fed to continue to raise rates and engage in balance sheet reductions until some combination of higher real rates and lower risk asset valuations are achieved. We expect a 50 basis point hike in May and the announcement of balance sheet reduction as well. The line from Citi this morning. Up next, your trading diary. This is Bloomberg. about 5 minutes' time, Guy Johnson, Gina Martin Adams picking up on a price action for you, trying to explain the last few days. We're unchanged now on the S&P, on the Nasdaq down about 0.1%. That's the price action. Here's the trading diary. Picking things up with Secretary Blinken speaking on the war in Ukraine at 1:30 Eastern. President Biden and China Xi talking Russia tomorrow. That is a really important conversation. More central bank decisions on deck with the Bank of Russia and BOJ+. Plus, we'll hear from the Fed's Barkin and Bauman. The Fed speak, no doubt, will continue next week. From New York City, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So we're 30 minutes into the US trading day. It is Thursday the 17th. What do you need to know? What are the top stories that we're going to be following for you at this hour? Well, the Kremlin downgrading expectations on peace talks progress. President Biden is going to speak to China's Xi Jinping tomorrow. What comes out of that? We'll discuss. The Bank of England follows the Fed and hikes by 25 basis points. But the focus is on the risk of growth slowing down rather than the risk of rising reflation. Almost a complete 180 of where we were with the Fed. And the chaos in the nickel market continues. The LME's trading system hit by further technical glitches despite the exchange widening its trading limits. We'll talk more about that as we work our way through the hour. From London, I'm Guy Johnson. In today, Gina Martin Adams. She's in New York. Alex Steele is off. Welcome back, everybody, to Bloomberg Markets. Gina, do these markets make sense to you right now? Does the reaction to the Fed make sense to you right now? Equities in the United States up again today.
Yeah, well, listen, I think we had priced in a lot of the Fed action as of even the decline that we saw in the U.S. markets in January. So the equity market was well prepared for what the Fed said yesterday. We've literally priced in more than anticipated before any tightening cycle we've seen since the 1970s. So it's been a very rough start to equities, and I think you have to keep that in mind. Also, the narrative really shifted over the last few weeks on account of the Ukraine and Russia war. Equities were starting to get very concerned about inflation. So this is a bit of a relief that the Fed is indeed going to stick to the plan, is indeed going to do what they can to remove this extraordinary policy support that has existed now for 2 years.
Very different responses from the bond market and the equity market. Different signals, very different signals in so many ways. A headline crossing the Bloomberg. U.S. mortgage rates rising above 4% for the first time since, I need to just double check this one to make sure I get the date right, 2019. If Alex Steele was here right now, she'd be crowing about the amazing rate that she managed to lock in. As I say though, bond traders trying to figure out exactly what they should make of what we got yesterday from Jay Powell and the FOMC. Certainly I think there is a disbelief maybe that the Fed can deliver the kind of tightening that is being priced in by the dots. The gap between 5s and 10s inverting for the first time since March 2020. Let's kick this around. Let's kick the different kind of reaction we're getting from the equity market and the bond market around. We've got Gina here. We've also got Ira Jersey, US rate strategist for Bloomberg Intelligence. Ira, let's talk about this. Equity market signaling one thing, bonds signaling another. You've got a flatter curve, though we're getting a little bit of a gyration now in the middle of the curve. Talk to me about what the bond market is seeing in what the Fed is doing. Does it believe that actually growth will end up being a bigger problem, and as a result of which, maybe a recession is coming further than more quickly than anticipated, and as a result, we're getting this flat, inverting curve?
Yeah, the yield curve is going to invert. When you look at the forward markets and what the market's priced for a year from now, almost the entire yield curve is being priced to invert, and that historically has been a signal that we get a recession. I think the question for risk asset markets, so things like corporate credit spreads and the like, is will it be a shallow recession that is kind of relatively, I don't want to say benign, right? Because there are real world effects on individuals and families and businesses when you have a recession, but is it a slow, shallow recession, or does it wind up being more of a very significant crash? And I think part of that will depend on whether or not the Federal Reserve delivers on what it's said yesterday in its statement. And if it does hike 7 times this year and another 3 times next year, then there's a strong possibility that you could have a relatively deep recession, just because you'll wind up with the economy slowing too quickly and people getting really nervous about making new investments. But if they go maybe a little bit slower, then maybe not so much. And one way or the other, Jay Powell yesterday said that there's not going to be a recession in the next 12 months. I think that's true. But, what he didn't say is, there's probably going to be one in the next 18 months, which I think is a little bit of a nuance that the chair avoided yesterday.
Ira, could you talk to us a little bit about the reliability of those forward curves in predicting recession? I think the equity market is counting on somewhat unreliable signals from the bond market and really sticking to the near-term signals from the yield curve as opposed to those forward curves, suggesting that maybe there's an out. Maybe the forward curves are wrong and ultimately will adjust in the other direction. Talk to us about that history.
Yeah, so the only way that happens is if the Federal Reserve doesn't deliver the hikes that they've said they're going to. Part of this is a little bit mechanical, but in order to get long-term interest rates much higher, you need to have one of two things occur, or both. One is you need to continue to have inflation expectations more or less where they are. Looking at my Bloomberg terminal right now, around 2.84% for 10-year Treasury yields. But the market still has very negative real yields, and the way to get real yields higher is twofold. And one, the Fed will deliver on, and that's quantitative tightening. So reducing the size of its balance sheet, typically, at least the 2 times that it's done it in the last decade, is you've seen real yields move significantly higher. That's number one. Number two is you have to not avoid a recession, right? So real yields tend to go down during a recession because you wind up having growth rates that are pretty low, low, if not negative. And so investors kind of, think that you're going to have real yields that are going to be negative because the Fed's going to ease monetary policy and the like. So in order for those forward curves to reverse, I think you have to have just a more dovish Fed than you have right now.
Gina, I'm going to kind of throw that back at you. The equity market lives much more in the here and now than the bond market does. What predictive power do you think the equity market has, given especially the fact that we now have maybe more of a focus on long duration assets, particularly when it comes to the tech sector?
Right. Well, I think the equity market is pretty good at actually predicting recession and usually falls by up to 20% in advance of recession. Over the year in advance of recession, we've already fallen by 10, which I think is somewhat reflective of this outlook for much tighter policy. We're not pricing in any sort of deterioration in growth anytime soon. And when Ira tells me, we may have a recession in 2024, the equity market is going to default to, who cares? 2024 is 2 years from now. We're not going to price in a recession 2 years from now until we start to see earnings growth deteriorate. So I think what the equity market has done is really focused on the rates aspect. Valuations have come in line with the idea that rate policy is certainly tightening. The Fed is moving into a new regime, if you will, of significantly more hawkish conditions. But we're not seeing in the equity market any deterioration in growth. I mean, the earnings numbers are pretty good indicators of what to expect in terms of the growth input for equities. And earnings estimates are still very strong, indeed abnormally strong for this point in the cycle. So we've got to see significant downward pressure emerge on those earnings estimates before the equity market starts to get more nervous about recession, frankly.
Ira, does anybody have a clue right now really what is going on? We basically, what we're dancing around here is the idea of which market is best at predicting what is going to happen. And I'm not sure anybody's got a particularly good clue what is happening right now. Oil markets all over the place. You've got geopolitical tensions. Really unclear what happens in China next. We talked to Nathan Sheets yesterday, the global chief economist over at Citi. This is what he had to say on the predictive power of economists right now.
We're looking at energy shocks. We're looking at a massive increase in just global uncertainty. The guidance that our models can give us are very, very limited. And I think that, we're going more right now just by gut instinct.
Ira, do you think the bond market's operating on gut instinct right now?
I don't think so. I think that the bond market right now is reacting to the monetary policy situation as well as inflation, right? The reason why you have 10-year Treasury yields above 2% is because you have such high inflation, and inflation expectations, according to the bond market, like I mentioned before, are still looking for, over the next decade, inflation averaging nearing 3%. And that would be a significant sea change from the last 2 decades when you had inflation hovering, around 2% plus or minus a little bit. So if inflation expectations stay where they are, then you're likely to have, 10-year Treasury yields somewhere 2% or north of 2%. And then the question becomes, is if the Fed delivers on its monetary policy, I don't want to call them promises, but its current expectation for where monetary policy could go and how significant the inflation threat is to them, then you will have, interest rates be somewhat higher than they have been over the last decade since the global financial crisis. So I think what's going on in the bond market is very rational, but I think what the bond market is trying to figure out is, how to live within some of this uncertainty that you mentioned, Guy, right? Like, will there be a slowdown in China and Europe, for example, that might significantly hurt the global economic outlook, and will the Fed be able to go that 7 times that they've said, and the market is priced for that right now, so that can change significantly over the next couple of weeks.
I find it just fascinating to compare and contrast what's happening with the Fed and the Bank of England, both hiking 25 basis points in the last 24 hours. The Fed focusing on strong growth. We need to get a handle on inflation. The Bank of England turning tail completely, focusing on the growth aspect, worrying about the income squeeze. Inflation's going to rise, but we're going to focus on growth. Ira, we're going to leave it there. We could carry on for ages. Ira Jersey of Bloomberg Intelligence, thank you very much indeed. Up next, we're going to talk about the Kremlin putting a damper on reports of major progress in peace talks with Ukraine. We're going to have the latest developments. That's next. This is Bloomberg.
Bloomberg.
War in Ukraine rages on.
Ukraine will never be a victory for Putin.
What is happening is a genocide of Ukrainians.
Putin must fail.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
1.2 million people have crossed into Poland.
The Children's Hospital, the latest target. Putin has gone all in.
And analysis of what it all means to you.
The corporate exodus continues.
For every daughter the United States could lose, the European Union stands to lose 10.
Keep it tuned to Bloomberg Television and Radio.
They're using their superior knowledge of the terrain and their own geography, as well as their nimble behavior in terms of using these systems they're getting quite effectively, and they have essentially stalled the Russian advance.
That's, of course, Pentagon Press Secretary John Kirby speaking in an exclusive interview with Bloomberg's Maria Tadeo a little earlier today. Meanwhile, a Kremlin spokesman saying that a report of major progress in talks with Ukraine was, quote, wrong. We're joined now by Bloomberg's Washington correspondent Anne-Marie Jourdain to talk further about this. Anne-Marie, Maria just pinging through a note on the terminal, talking about the idea that actually what we've also got going on here, and we should also pay attention to, are talks that are happening between Ukraine and Turkey. Erdogan has a fairly good line into the Kremlin as well, and the idea here is that maybe we could be setting up a conversation between Zelensky and Putin. Given your reporting, how likely is that, do you think?
Well, both governments have said that a meeting could be on the table. President Zelensky has said that very publicly, but Sergei Lavrov, Russia's foreign minister, has said in the past that a meeting could happen, but there would need to be justification for that, an endpoint, a means to that meeting. And right now, when you have the Kremlin saying that Financial Times report that there was progress in these meetings, calling that false, Ukrainians yesterday I spoke to said to me that they don't see any significant progress, and they point to the fact that those bombs are not abating on Ukrainian infrastructure, on cities filled with civilians. So I find it challenging to see that a meeting could happen soon unless the Kremlin was very serious about potentially a ceasefire at this moment. We should also note that President Putin has talked pretty much disparagingly against President Zelensky. And if he was to sit down with him, that would almost legitimize him to the Russian people. I'm not sure the Kremlin is ready to do that just yet.
Anne-Marie, you're right down there in D.C. Talk to us a little bit about the sentiment out of Washington this morning after that video address from Zelensky to Congress. Do you sense there is even more momentum behind providing support to Ukraine, maybe sending more folks in to help in negotiations?
Well, right now what you have following that incredibly emotional, impassioned speech from President Zelensky is, of course, a lot of pressure on the administration to act. But President Biden yesterday announced more arms to Ukraine. That included drones. And these drones seem to be a very welcome outreach from the administration to Ukraine. They could be very helpful. You had John Kirby talking to Maria about all the military and economic support they have given to Ukraine. But what we do have, of course, is the president going to Europe next week, and also a very critical phone call tomorrow between President Biden and Xi Jinping, potentially maybe trying to get China on board to influence President Putin.
Thanks for the update, AMH in D.C. Thank you. Bloomberg's Anne-Marie Jourdain. This is Bloomberg.
About that all day yesterday.
So the Fed hiked by 25 basis points last night, the first time it's done so since 2018. Chair Powell signaling there will be 6 more coming this year. The bond market, it's unconvinced. It thinks the Fed is going to struggle given the growth impetus is going to fade, that the Fed will be able to deliver on those hikes. Karen Altambour, Bridgewater Associates co-CIO for Sustainability, joins us now. Karen, you still think the Fed's behind the curve. The bond market thinks it's going to struggle. Give us your view.
The bond market is basically pricing in a relatively moderate increase in interest rates when you put in perspective just how far inflation has risen. And if you break down the bond market pricing between the real interest rates and the expected inflation, which you can do, of course, with the curve on inflation-linked bonds, you can see that while inflation is expected to be high for the next year or so, maybe 2, it's expected to pretty quickly come down afterwards. That's why longer end rates are relatively low. And so more or less, the bond market and the stock market together are pricing, kind of a magical scenario where the Fed tightens not that much. It doesn't kill the expansion because you still have equity prices doing what they're doing, and inflation magically comes down. And if you look at history, that looks pretty unlikely. And it really, to me, echoes of what happened in 1973 when inflation pressures were already the highest had been in a long time. Then you get a big geopolitical shock that's exogenous. And it's just not pleasant to be in the Fed's shoes and tighten into an exogenous supply shock in commodities that has to do with geopolitical events, doesn't have to do with domestic demand. It's just easy to fall behind the curve in that situation when you're reasonably worried about the stagflationary impacts that could happen. But you saw what happened in the 70s. It's very easy to fall behind the curve, and it's a very bad situation for investors.
Karen, I think the equity market anyway, at least my perception of the equity market is that they're sort of leaning on the employment situation and the steady growth as indicated by employment figures, which is certainly a key characteristic difference between now and 1973 when unemployment peaked or troughed all the way back in 69 when it was on its way up persistently over a period of years into that 73 correction. Can you talk to us a little bit about your outlook for growth and how that's playing into your thesis that this is another 73? Are there key differences that we should be mindful of, and do you see something more nefarious coming for the employment markets?
No, I agree with you. I think growth is incredibly strong and self-sustaining. And really inflation and how difficult it is to contain inflation is the main parallel. You have a very strong cyclical expansion that at this point is very self-sustaining. It started out getting stimulation from both the Fed and fiscal, but once you get that going and more income creates more spending, more income creates more spending, it tends to be incredibly self-sustaining. And that's why you see inflationary pressures everywhere. It's very broad. It's not in one area where there's a particular supply constraint. You see it pretty much in every sector, everywhere you look, and that's why it's going to be so hard to cut it off and probably require a lot more tightening than currently being priced.
Karen, if this is 73, where do I want to be? Where do I not want to be?
Well, the thing you learn is that nominal bonds are the worst possible thing you can hold because as inflation keeps picking up, as the Fed needs to tighten into that, the bond market tends to lag that move. That's probably the last thing that you want to hold. Probably the easiest switch to make if you need to hold bonds is to just switch them into inflation-linked bonds because then you will just get paid whatever CPI prints. And you've seen over the last, few months already what it's been like to be an inflation-linked bond investor relative to a nominal bond investor. You're getting paid those prints as they're coming in very high. You get paid headline inflation, whatever it prints. In addition to that, most people don't have a lot of commodity exposure. And from my perspective, that is one of the best possible ways to diversify your portfolio, to have a very direct exposure to those supply shocks remaining, to having demand continue to outstrip supply, and to having a squeeze across all the things that we use.
Karen, given your role as co-CIO of sustainability there at Bridgewater, I think we'd be remiss not to, leverage your insights on what's going on with the energy materials space as well as generally sustainable supply chains around the world. Your team's done this great work recently talking about, the necessity of governments getting engaged and spending on a transition to cleaner sources of energy. How do you see what's going on in the world right now as either promoting that thesis and really pushing governments in that direction, or potentially even detracting that idea and really pushing it to the back burner as we contend with this crisis?
Well, I think that there's a strong political consensus, especially in Europe, that climate change needs to be curbed, and we need to transition our energy infrastructure and the world's energy base away from where it is today to one that has significantly lower emissions. That said, there are two basic ways to do it, and they make sense. One, you could take all the quote unquote bad things like oil, coal, things that create carbon emissions, and raise their prices, whether that's through carbon pricing, through stopping the supply. The other thing you can do is subsidize the good things, make the renewables cheaper, directly spend fiscal resources on expanding renewable supply. And what was happening ahead of this crisis is a lot of the efforts to curb climate change, where governments were most serious about it, like Europe, were very focused on raising the prices. So carbon pricing, taking coal offline, that sort of thing. Now you get this big shock, and you're basically having energy prices rise in a way that's not that conducive to tackling climate change, because obviously the squeeze on something like natural gas, less bad for the environment, is much less bad and much worse than the squeeze on, say, coal, which is significantly worse. And in my view, the political will to keep tackling climate change through raising energy prices is going to fall. It was already very low. It was impossible to think about carbon pricing in the U.S. Political will to do it into this environment, it's just not going to make sense to use these inflationary tools of raising energy prices being the way that you try to address climate change. The path to deal with that, and you're seeing Europe already eye at this and start kind of hinting this direction, is to go make renewables cheaper. Go spend, go have big fiscal programs and double, triple your efforts to go get more renewables online faster.
Carol, in 30 seconds, how has the war changed the ESG outlook? What is ESG? Any thoughts on that?
I think that the response you're getting in the private sector, from private sector capital to the war, in terms of the moral outrage from Russia's behavior translating to real action, is way far beyond what anyone had imagined the private sector could do. I think that if we were talking about this before the invasion, we wouldn't even be mentioning things like, is Russia reliant on payments from Visa? What if McDonald's closed all its stores? The response has been swift, it's been rapid, and it's happening at asset owners, it's happening at consumers, it's happening at employees. And to me, this is a new bar of what ESG can be, what it means to have a private sector response. And it's only a matter of time before people say, wait, if you can do this on Russia, why not on climate?
Karen, we've got to leave it there. Thanks for your time. This is Bloomberg.
us.
So we're an hour into U.S. trading. What's going on? Let's find out. Abigail Doolittle tracking all the action. Over to you.
Well, guys, certainly an interesting session. And we're looking at the first three-day rally for the S&P 500 and other major indexes that we've had since early February. This, of course, into and out of the Fed. The S&P 500 right now up 0.2%, reversing a pre-market loss. So investors taking a little bit more of a constructive view, perhaps thinking that the Fed won't be able to stick with their plan or that somehow that there was some sort of a bit of a dovish tilt. That's also showing up in bond yields. That 10-year yield coming in 4 basis points after an extraordinary backup in recent weeks. You can see the one outlier here is the China Tech Index, that Golden Dragon Index. Extraordinary yesterday, up 33%, the best day, not surprisingly, ever. I cannot remember a legitimate index or, frankly, stock. I mean, stock maybe so, but index ever climbing 33%. And that, of course, a lot of different factors in China, including the fact that Beijing was talking up the stock market to some degree, or liquidity, plus the idea that lockdowns aren't going to be quite as bad. That's helping out oil. We have oil popping back higher, Brent crude back above $105 per barrel, on the idea that the world's second largest economy is not going to be offline. As for what could be next for yield, yesterday I was showing a very simple chart saying that we could see yields come back in. This is another way to look at it. This is what I call an ugly range. More technically, it's a broadening formation. It tends to be a bearish formation, but forget about the outcome of it. It looks as though we could see yields go back toward the bottom, a defined set right around 175. That also would be in line with momentum going back to the bottom. So we may see a little bit of a easing of the backup in yields that we've had. If that's true, homeowners and buyers, actually I should say home buyers really, and sellers for that matter, will be happy, because we do have that 30-year mortgage back above 4% for the first time going back to 2019. That could psychologically be difficult, but Guy, I wanted to show this long-term chart. That's nothing. So if above 475, that would be above, let's call it the 10-year average. But look back 20 years, we're closer to 8%. So still very, very low. But every little bit here could be a big psychological difference to folks in the housing market here in the U.S.
I'm a child of the 70s. I remember rates being even higher than that, or certainly my parents complaining about them. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle. Let's turn our attention to what is happening in China. The coronavirus lockdown in the city of Shenzhen means more problems for global supply chains. Now let's talk about what Shenzhen is. It's more than just a tech hub. It's also home to one of the world's busiest ports, as you can see here. Now most of these ports are in China. These are measured by millions of 20-foot equivalent units, i.e. containers. Shanghai at the top, Singapore, Ningbo. Then we get to Shenzhen before we get to Guangzhou. These are huge ports. Closing down the ports obviously having a major impact in terms of global shipping, also having a major impact in terms of the tech sector. The Shenzhen lockdown forcing Apple supplier Foxconn to temporarily quit making iPhones. The company has now resumed partial operations. In fact, we're seeing some of these restrictions being rolled back. But nevertheless, the impact is going to be significant. We learned certainly during the pandemic the impact that these port shutdowns can have in terms of supply chains. So let's talk about the potential impact in detail and what it's going to mean in the United States. We're joined now by the Executive Director of the Port of Los Angeles, Gene Soroka, joining us now in New York. Gene, we've seen this movie before. We've seen these shutdowns happen. What impact do you think it's going to have this time?
Well, good afternoon in London, Guy. We're watching this very closely, keeping up with our colleagues overseas, but we're also watching the impacts around closures of these factories. That's going to be key. As we've witnessed in the past, the Pearl River Delta area of container terminals and ports allows us to move that cargo around. So if the port and complex in and around Shenzhen, specifically Yantian container terminal, shuts down, we can move to the west side over to Chiwan or up the coast to Nansha, Guangzhou, Dongguan, etc. But it's the factory segment that we're going to be watching. The pause will be minimal compared to what we've seen in the past, but then when they come back to work, they're going to need to catch up on orders. So we will probably see a lull in 4 weeks' time based on these closures, and then a pretty quick rebound when workers come back. That gives us some time to work down the cargo that we have here now and be prepared.
Gene, have you seen any impact of the Russia-Ukraine crisis yet? And if you do see an impact, how do you expect that to play out?
No impact on freight. Port of Los Angeles only has less than 0.2% of its cargo. originating or destined to Russia. But what we are watching are the flow of agricultural commodities and where the world markets are going to have to pick up to help the European Union. Second, we're watching very closely on the distribution of energy products as the world is right now. And equally as important to us, the cyber threatscape. We've got the nation's first and still only cybersecurity operations center. It's now stopping 40 million intrusion attempts a month, and that's double what it was before COVID-19.
Incredible.
Wow, that's an incredible number. Let's talk about what we're seeing in the U.S. economy right now, Gene. You are obviously the gateway for that economy in so many ways. The Fed was talking yesterday about the strength that it still sees in the economy, the demand that it still sees in the economy. What are you seeing? Any sign of things slowing down, or is this an economy that is still roaring ahead?
It still is moving very fast, Guy. January and February were all-time record months at the Port of Los Angeles for container flow in and outbound. We're also seeing that the second quarter, as projected, will be major retailers and home improvement stores building their inventories back up. We're at the lowest inventory sales ratio we've been in the country for over a decade, and that needs to pick up from a safety stock perspective. So while this lull may be coming because of what we see in South China, and that's about a third of all of our cargo, we're still going to see a very strong Q2 coming off a good first 2 months to start the year.
I'd like to move a little bit to policy, because I know we've had a new initiative from the Biden administration supporting the supply chain data flow. Talk to us about what that means in terms of what will we get out of this new initiative?
Yeah, it's about interoperability and having these major players in the supply chain share their information. Okay. In Los Angeles, we've got the country's only port community information sharing system through the Port Optimizer. We're decades behind other trading nations like Germany, Belgium, Singapore with their systems. The idea is from service providers to cargo owners, importers, and exporters, get your data into a multi-dimensional platform so we can start seeing around corners and over hills, preparing for spikes or declines in business much better than we're doing today. As a country, we're working off of spreadsheets and conference calls. We need to improve that data share, and that's exactly what Flow is going to do.
And if I could follow up on that really quickly, how does that then pair with what you were talking about with cyber attacks? What will be the security measures put around such a comprehensive system of information to ensure that cyber attacks don't impact that data?
Yeah, Gina, that's a necessity, and that's why we've gone from the Cybersecurity Operations Center to a Cyber Resilience Center, which for the first time brings the private sector in under the FBI's Neighborhood Cyberhood Watch program. If someone gets impacted, they can share that data. We can synthesize it across the port community. We've got to now scale that nationwide.
Gene, in terms of the bottlenecks that you're experiencing right now, you and I have talked over the last 18 months, 2 years, as we worked our way through the pandemic. It's been people, it's been trucks, it's been all kinds of things that have caused bottlenecks. Where are they right now?
The port's in much better shape, Guy. In fact, cargo velocity has increased so much that over the last 30 days, we've moved out 16% more cargo than we did in the fourth quarter on average. So the productivity to get goods into the domestic supply chain has improved tremendously. But we still have 55% of our truck gates that go unused every day. We've got to continue to encourage the cargo owners to pick up their goods when they come in, not use the port as a warehouse, but as a transit facility as it was designed. We've got latent capacity right now to catch this next wave of cargo.
Why do you have so much of that capacity open? What is the holdup? Why aren't the trucks picking up the goods at this point?
There are many reasons, Gina, operationally, process-wise, information sharing-wise. But what we've seen is a lot of the big retailers have ordered just in case, not just in time. So we've got to do a better job as a community segmenting that cargo. So if it's not needed in market right now, just move it to the side. So those critical goods, 20% of all our imports are manufacturing parts and components. We've got to get those to the factory floors. The devices for our hospitals and medical community and other time-sensitive products. If we can keep segmenting, we'll do a good job of moving cargo velocity through the port system.
Gene, what kind of inflation rate are you seeing right now? The Fed thinks it needs to stamp on inflation and stamp on it hard. What do you think? What are you seeing?
Well, there are two sides to this coin. Obviously, everyone is focused on inflation. We feel it at the grocery store, at the gas pumps. Even the cargo prices are still very high for the container level business. But with more than $1 trillion in American savings accounts, we still see retail sales pumping through. 0.3% growth in the month of February. On top of that, adjusted 4+% retail sales growth in the month of January. That's a really, really fast start to the year, and we don't see any let up just yet.
I'm sure, Gene, you keep a pretty close eye on the competitive dynamics between LA ports as well as the other ports around the United States. Any telling signals we can derive from the differences between what's happening in LA and, say, some of the East Coast ports or even more northern West ports in the U.S.?
Gina, we see bottlenecks throughout the supply chain, even at the ports on the East and Gulf Coast. We've got to find a way to improve the flow of those goods and bring back certainty to the import and export community. We've also got to connect that exporter back to their market. The exporter needs visibility on containers, truck and rail service, matching up with vessel services. We've got to smooth out these curves as quickly as we can. Information flow is a part of it, but even in the Southeast United States today, we have vessels off the coast waiting to dock and be worked. It's not simply a Southern California phenomenon anymore.
Gene, it's always great to catch up. We really appreciate you coming in to see us. Gene Soroka, Port of Los Angeles Executive Director, sir. Thank you very much indeed. A little headline coming through from the Chinese news agency Xinhua. President Xi to exchange views with Biden on topics of mutual concern. The focus of this conversation certainly, I would expect, to be firmly on what is happening in Ukraine right now. We don't know much detail about this call that is set to take place tomorrow between the leaders of China and the United States. When we get that, we will bring it to you. This could be one of those pivotal moments that we need to pay a great deal of attention to. What are we going to do next, though? Tesla puts a $1 billion bond issue on hold. It's the third issue in the past week to push pause on a major bond sale. We're going to look at what's going on in the primary credit markets next. This is Bloomberg.
Keeping you up to date with news from around the world, here is the first word. I'm Rishika Gupta. The expanded arsenal that the U.S. is sending to Ukraine includes 100 armed drones. Bloomberg's learned that the drones are tube-launched from the ground and plunge into their targets. It's called the Switchblade and is made by Aerovironment. President Biden has also promised thousands of anti-aircraft and anti-tank missiles. White House coronavirus coordinator Jeffrey Zients has plans to leave the Biden administration in April. He'll be replaced by public health expert Ashish Jha of Brown University. Zients spent much of his time securing the purchase and distribution of vaccines as well as treatments, tests and protective equipment. And Bloomberg's learned that Tesla has put a bond offering of more than $1 billion on hold. The bonds that were backed by leases on its electric vehicles and the portions of the deal had already been sold to investors, but surging inflation and concern about the war in Ukraine have sent short-term rates higher. That's prompted issuers to put their plans on hold until markets have calmed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg Guy.
Rishika, thank you very much indeed. So Tesla, not the only company to put a bond sale on hold recently in the primary market. In the past week, the auto finance company Omni and Affirm did the same thing. Let's talk more about the credit markets and what is happening in the primary market in particular. Bloomberg's Sonali Basak joins us now. Sonali, Rishika just said that Tesla's putting its bond on hold until markets have calmed. Is there an expectation that the primary market is going to calm? I appreciate that it's pretty much stasis right now, but is there an expectation that things are going to calm down and we'll be able to have an easier pricing environment anytime soon?
And for what asset, right, Guy? You see what's happening with the ABS market. You had Tesla, you had Affirm, you had World Omni, like you had said. But if you look at the IG market, you do see you have some major bond issuances coming back. Just look at that $30 billion offering from AT&T and Discovery's combined media business just last week, GlaxoSmithKline. My sources are really saying right now, Guy, Gina, that there is some demand and some ability to get big U.S. IG deals done. Europe is in a really hard place right now, but then if you go down to anything a lot riskier, high yield, ABS, leveraged loans, that's when things get a lot tougher.
What trigger would they be looking for to come to market then? What is it that they're looking for in terms of volatility or rates or signals that would make them feel more comfortable?
Well, one thing that's interesting with rates is you have to wonder if a lot of this is happening to get ahead of the rate rises when it comes to those large bond deals that we had just mentioned. But when you look at also the volatility that's in the market, that's really still what's spooking people. It's not the absolute prices. They just want prices to be stable so that no issuer or investor is leaving money on the table here. If you look back and see what is happening to the indices themselves, I want you guys to take a look at what's happening to the Bloomberg high yield index here. It has fallen off quite a bit. And a lot of the private equity players, Guy, you and I have talked to KKR, for example, see that as such a great buying opportunity here. So for a lot of people, it's the perfect time to enter, but they just can't do it when things are whipsawing.
Well, okay, so what kind of trades would they be putting on?
Well, the steep drop-off you're seeing in the index there, the reason I want to pull it up also is because there's a lot of people who are thinking this is the perfect time to go short certain bonds, to go short certain markets, let alone treasuries. So that's one major trade we're seeing out there. We're seeing some of the people with a higher risk tolerance say that distress and that both in the sovereign area, by the way, that is sold off with kind of the rest of what's happening in EM, as well as what's seeing in corporates. The spreads are going to come back in at some point, but they're wide enough now to get into. But again, it is only for those with not the faint of heart, right? It is the people who are able to get in, but a lot of people here on the sidelines.
I know you've had a lot of conversations over the last week with investors in this space, as well as the issuers themselves. And it does seem to be more about volatility than anything else. How many people are starting to talk to you, though, about the broader impacts of Russia, Ukraine, and global risk and geopolitics, and maybe starting to say, okay, maybe the growth outlook isn't so good anymore?
Yeah, that's a huge part of things. There's a lot of credit investors in particular where stagflation is much more of a conversation than you're seeing for the equity investors, which are maybe not thinking about it as much, have a little bit more optimism. The credit investors are also worried about the margins and the eroding of the equity base here because they're saying there's just a little less cushion there than there was before. So, you know, a lot of people are talking about the divergence there. Actually, they're a lot more connected than you would think. But on geopolitics, that's why I had mentioned Europe as well. The U.S. is still such a big safe haven here when people are really worried about that growth slowdown in Europe more than they are in the U.S. So they do see it coming here as well.
Right.
Sonali, nice reporting as ever. Thanks for bringing it to us. Sonali Basak, thank you very much indeed. Coming up, It was another day of chaos at the London Metal Exchange. Nickel markets are having problems reopening. I think that's the understatement. Details next. This is Bloomberg. So it continues. The London Metal Exchange Nichols market has been paralysed once again today by glitches. It comes after, of course, that week-long suspension. When do we get to a clearing price? When does this market start to function? For the daily instalments on this story, we turn once again to Bloomberg's Mark Burton. Mark, bring us the latest.
Hi. So it was another unexpectedly frenetic and chaotic start to the trading day in the nickel market, where we had a case where there was a new trading limit imposed at 8% of the prior day's closing price, but when brokers came to put orders in at that level this morning, they found that their orders were cancelled. And that led to a rapid effort to recalibrate those trading limits to allow the trades to be placed, which they were, and then inadvertently the LME opened the market about 4 minutes early and allowed a number of trades to take place before suspending it again, and trading resumed in a slightly less chaotic fashion at 8:45, but it remains incredibly illiquid. So far today, two contracts have traded on the LME's electronic market. On the day before trading closed on Monday, trading volumes were about 25,000 lots. So the market is truly paralysed. As things stand, there are about $3.3 billion worth of orders in the system to sell nickel at the limit down price, but it's now a question, as you say, of just trying to find a clearing price. The expectation is that prices are going to need to keep opening lower each day until they calibrate more closely with prices that are traded on the Shanghai Futures Exchange, which has remained open throughout this whole saga in London. The precipitating cause in all of this, of course, was the sharp rally in prices and the huge margin calls that created for bearish investors, bearish traders, and one entity in particular, Tsingshan, as we've reported. that short position still needs to be covered. And so at some point, there is likely to be a very frenetic break in this paralysis that we're seeing in the London market. It's just a question of when. Currently, the London market is quoted at about $42,000, and equivalent prices in Shanghai are at about 30,000. So we could have another few days yet of limit down trading before we.
Mark, the longer this goes on, you have to wonder if it doesn't spread to other metals or other assets traded on the exchange. Are you seeing any signs of spread, or is this really isolated to nickel so far?
Well, as we've seen, there's been a lot of commentary among hedge funds, among traders who are extremely frustrated with the way that the LME has handled this, and they're making the decision to pull their trades off the LME entirely. So there is some spillover already, and there's a question as to how bad that will become. And on the face of it, it looks like there could be some very significant contagion, as you say, and the timing could hardly be worse for the LME. You know, this has been a 2-year bull market in the metals markets and commodities more broadly, and prior to the closure, trading volumes were absolutely flying, having kind of rebounded from a fairly sort of languid period over the past couple of years.
Okay.
So to have pulling off is bad news.
Mark, great stuff as ever. Our daily update on the LME. Mark Burton, thank you very much indeed. Coming up, Madeline Jones of Oaktree Capital. This is Bloomberg. Thursday, March the 17th, European stocks fade. The next hour of Bloomberg Markets starts right now.
From From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Okay, the price action looks like this here in Europe. Stock 600 down near session lows. We're down by 0.3%, trading at 447 spot 18. Equities definitely fading. The only exception is the London market, because in some respects we are seeing commodities coming up. We're also seeing the pound coming down. The cable rate trading at 131.24. The reason for that, a little bit of a surprise from the Bank of England. Certainly turning significantly more dovish today in terms of the messaging, despite delivering a 25 basis point hike in line with the Fed. We'll talk more about that in just a moment. Talking of the energy markets, which is one of the reasons why we're seeing the London market getting a lift, we're up by another 8% today, bouncing back on crude. We're back north of 106.07 for the global benchmark that is Brent crude. Within the last few minutes, Emmanuel Macron, the French president, indicating that the French government, the French state, may have to take control of some of the energy companies as we see this energy effect, this stagflationary effect ripple across Europe, consumers getting hit hard by higher prices. The state needs to step in. We're getting a fiscal response, but it may mean that actually we see the state taking control of some of these assets. Let's get a check on where we are stateside. Abigail, over to you.
Well, Guy, that big surge in crude oil, that could be one reason that we have flip-floppy markets over here in the U.S. The S&P 500 now down about 0.25%. The last time we were taking a look at the markets, up about 0.25%. However, one reason to think that we could see stocks close higher, maybe we'll get a 3-day rally. LQD, the investment grade credit ETF, it is up for a third day. Its best 3 days going back to April 2020. So that's a sense of risk on. So credit is rallying here, at least through that ETF, again suggesting that maybe we'll see stocks follow through with a third up day as well. You can see the yield curve, that 210 spread is flattening once again. Now after it inverts, if it does invert potentially, something we've been talking about all year, that could of course mean that a recession is ahead, but into the inversion often that can be positive for stocks. So stay tuned. And then finally the dollar down for another day. That dollar index down about 0.5%. In theory, that should be good for risk assets. It's certainly helping out the commodity spaces. It's not just crude oil that's surging, Guy. We have a nice commodity rally right across the board.
Absolutely. What is interesting is that the pound is down, but we're seeing a rally in the euro. Abigail, thank you very much indeed. What are the reasons for that? The Bank of England raising its key interest rate today. That's the third time it's done that in a row. However, it is warning that inflation could go above 8%, but it is worried about what is happening with the income squeeze. The Bank of England move, of course, comes day after the Fed hike rates by 25 basis points, but signals strong growth ahead. That is the key difference here. The bank is focusing on what is happening with the growth slowdown. The Fed is focusing on the pickup in inflation, despite the fact that the UK also has a pickup inflation. So some people are calling this a dovish hike. Let's find out why. Bloomberg's UK economy reporter Lizzie Burden joining me now on set. Is that how we should think about this?
Yes, so for two reasons. First of all, we were expecting the big surprise today. We were expecting this to be a split between a 25 basis point hike or a 50 basis point hike. Actually, it was the other way, and it was an 8-1 vote split, and the dissenter was Deputy Governor John Cunliffe wanting to hold steady. So dovish in that way. And secondly, the future guidance, because in the previous wording from February, the minutes had said that they were further tightening was likely in the coming months. Now they've said it might be appropriate in the coming months. So now traders are pretty much wiping the prospect of a 50 basis point hike off the table at an upcoming meeting.
Lizzie, what's the Bank of England doing with the balance sheet right now?
Well, we don't know any more about it from today because we're not any closer to the 1% mark. That was meant to be the minimum level at which the bank would start actively selling gilts. It was never an automatic trigger, but the bank had said that it wasn't going to do that in a time of financial or economic stress. Clearly, the war in Ukraine presents both, so they haven't opted. I've controlled F through those minutes, and there's no sign of any more detail on QT.
In terms of, therefore, what comes next, this is a shift in focus for the bank. Previously concerned about inflation, this is another shift in focus from the Bank of England, should I say. They shifted to focusing on inflation, now they're shifting to focus on the growth slowdown. In terms of the kind of trajectory forwards. What's the degree of certainty for the bank right now? This is a hugely difficult environment for them to navigate.
It is a hugely difficult environment, and that's what they're emphasising, the two-sided nature of the risk.
Yep.
And that's something that the chief economist Hugh Pill has been emphasising throughout, but even more so because of the war in Ukraine. It really puts the spotlight onto the Chancellor, Rishi Sunak, next week. We've got the spring statement coming up. There's a great piece on the Terminal at the moment about how the Bank of England's now playing the bogeyman, whereas in previous crises it was the Chancellor. Well, now the pressure's on Sunak to raise benefits, put off the tax rise, or cut fuel duty. But the Bank of England is the one that's leading the charge to tighten.
If we dig in a little bit into the pressure on the Chancellor, what do you think is the most likely thing that the Chancellor approaches first when it comes to offering some reprieve from this endless drumbeat of inflationary costs?
Well, I think there are two things that he needs to deal with. There's the cost of living crisis's effect on consumers, but there's also how it's affecting firms. And so the latter point may be what he needs to focus his attention on. But if he doesn't deal with consumers, as I say, through benefits or through a fuel duty cut, that could create a real political headache for the Conservatives in the future, because as we can see from the Bank of England's forecast today, this isn't just a crisis that's going to affect the poor, though it will bite them hard. It's also going to drag in millions of people who've never had to worry about affording to eat or heat their homes. And Middle England is who elects the Conservative Party at the end of the day.
Great stuff, Lizzie. Thank you very much indeed for the reporting. Bloomberg's Lizzie Burden on what is happening with the Bank of England, and looking ahead, of course, to the upcoming statement from the Chancellor next week. What have we got coming up for you? The Kremlin denying a report that there's been a major breakthrough in peace talks with Ukraine. The latest developments, we'll have them next. This is Bloomberg.
People ask me all